Good evening. Welcome, everyone. Thank you for joining us for today's webinar themed Investing in These Times. My name is David Amosun, and I will be the moderator for today. Today, we are pleased to have two amazing guest speakers, inspirational and great communicators in their right. We have Titi Odunfa Adeoye, who is the founder and chief investment officer of Sankore Investments. We also have Olayemi Agbe Davis, who is the chief dealer at Union Bank. Following the unprecedented events that took place in 2020, the pandemic and everything that came with, the question beckons, what will the future of investments look like? Today's webinar aims to address this and topics alike. We will be discussing the current happenings in the economy, investment outlook for the rest of the year, and how to effectively invest and manage your portfolio during these times. It promises to be a very insightful conversation. Let's meet our speakers. Titi Odunfa Adeoye is the founder and chief investment officer of Sankore, an investment firm that offers investment strategy, product advice, and technology to individuals and institutions. Her areas of expertise include strategies for the creation, growth, and preservation of individual or family wealth, with a focus on alternative asset classes like venture capital, real estate, and agriculture. Titi holds an MBA from Harvard Business School, a BBA in accounting, summa cum laude from Howard University, and is a certified public accountant with a gold award. Olayemi Agbe Davis is the chief dealer at Union Bank. He has over 16 years experience covering trading activities across rates, credit, FX, and derivatives. Olayemi holds an MBA from Warwick Business School and a BA Honors in Economics from the University of Nottingham. Just before we begin, if you have any questions during the session, please drop them in the questions box, as we will be having the question and answer session right after the presentation. Over to you, Olayemi.
Okay, good evening, everyone. I'm sure by now COVID-19 is a household name. As we're all aware, COVID-19 came early in 2020 and spread at an alarming rate, infecting millions of people, bringing economic activity to near standstill and creating a lot of growth fears around the world. Governments imposed tight restrictions on movement to stem the spread of the virus, and that came with it attendant economic effects. Most economies saw little to no growth, while a lot of economies plunged into recession, with the single exception being China, who probably had the added advantage of tackling the virus more aggressively since it originated from Wuhan in China. Some of the figures you highlighted, you can see that in the US, we had negative 3.5 GDP growth, in the UK about negative 10%, and China, the only outlier in most of the developed economies in the world. Through our webinar, we hope to slightly highlight what happened in 2020 and also give you some form of an outlook into where we're going in 2021. So to talk more specifically about Nigeria, just to put things in context, Nigeria suffered from a drastic fall in government revenue. As you're aware, global output reduction led to crash in oil prices. We saw oil prices trade as low as $14 per barrel, even though we had a budget benchmark that was a lot higher at about $57 per barrel, which meant that the federal government had to respond by revising our budget benchmark to about $28 per barrel just to try and meet up with what happened in terms of the fall in prices. The central bank introduced some palliative measures, single-digit interest rates, and created loan classes to try and help reinflate the economy. We had an FX illiquidity crisis, which we're only just beginning to get out of, which also led to devaluations and depreciations in the exchange rates. We've seen the official rate go from about 307 to about 379. in the official window, and at the parallel market, we're currently somewhere around 485. Our foreign reserves also dropped significantly to close the year at about 35.4 billion. Central bank also responded by cutting the monetary policy rate by 100 basis points in order to try and stimulate some growth in the economy. And we saw a rapid decline in yields and in the investment environment, with treasury bills trading as low as 0.5% on the shorter end of the curve, and even on the longer end with bond yields trading as low as about 6% for 30-year yields. We've seen a persistent rise in inflation, we've seen GDP contraction, and we've seen slow growth. So the pandemic year was quite painful for the global economy, but also painful for the Nigerian economy. Let's move on. So just to put some more context into the pandemic, we also saw global unemployment skyrocket. Nigeria was not insulated from this. I think we peaked our unemployment rate, the last figures out from the National Bureau of Statistics, were about 33.3%, the second highest in the world at the moment, due to the attendant effects of the pandemic and also the shocks to our economy. I'll bring in Titi here if she has any thoughts on 2020 and how the pandemic affected the investment landscape.
Thanks, Yemi, for that. I think definitely we all know it was a year to remember. For many of us, it will be the only pandemic we ever see. So it was definitely a memorable year. I think you've covered most of it, but there are definitely a few key parts. Before I jump into just talking into more detail on markets, there are a few key things just based on what you said that I would like to highlight, just for our audience. I think, of course, it's impossible to ignore what is on the screen right now, which is what happened with unemployment. I mean, it's what affects all of us the most on a daily basis. The fact that we live in a country with unemployment levels at 30% is a big impact on all of us. It means we all have friends who are unemployed, we have family members who are unemployed, and so on and so forth. It's also going to affect us overall with regards to the level of safety in our country, the level of unrest in our country, and so on. And I think we all experienced that last year, so there was quite a lot of global unrest, and a lot of global unrest tends to be tied to just sort of the wealth status of people. So if you look at this slide where you just see unemployment rates globally be so elevated, it's no surprise that levels of unrest globally were also quite elevated, and Nigeria was not left out of that, which is sort of what happened around NSARS and all that kind of stuff. There are a lot of other things that happened that you've already mentioned. I think some areas that I would want to remind everyone before I even get into asset classes is, just the devaluation, which again affects all of us, and then just sort of the level of yields. We all came from an environment of yields being relatively high. We all remember T-bills at 22%, and yet by the end of last year, we were looking at yields as low as 2%. So definitely it was a year to remember. But taking it to markets, which is where we focus quite a bit, you can see on the slides that, it was an interesting year. And it also just sort of reminds everyone the importance of thinking long-term. Because you actually, if you look at the first slide on the left to the top, you can see, of course, that there was a quite drastic drop in financial markets from the pandemic, mostly in early March, right? But as you can see, most markets recovered and actually rallied significantly by the end of the year, right? It also tells you the importance of having just sort of a long range horizon when you're investing, because it's very typical actually for people to see things like this and then they rush out of the markets because they're afraid. But this also just shows you the resilience of many markets, especially if you have a long-term viewpoint. We always tell people that when it comes to, please go back. We always tell people that when it comes to equities, you want to make sure that you have a business cycle as your timeline. You can see Nigerian Stock Exchange as well did very well. In fact, we were the top performing market in the world last year. And that, of course, we did really well, about 40 something percent. Looking at bonds as well, you can see at the bottom, bond yields also moved quite strongly for much of the year. We actually have been seeing them now, however, go back up, right? So again, that makes a lot of sense. You know, the pandemic effect was, of course, a strong rush to quality, right? So you actually saw bond yields drop significantly, right? So especially in places like the US, but of course you would then see the opposite effect in markets that are considered riskier, like Nigeria, right? So we saw bond yields go up at that time, but US markets saw them go down. So that's why with that chart, you can see the US as just sort of a developed market that's considered a rush to, you know, that's considered a safe market. And then you see Brazil that's considered more of an emerging market, and they're mirror images of each other. So moving on, so that kind of covers what happened with stocks and bonds, but alternatives, which were quite interesting. I mean, of course, we can also look at things like commodities and real estate, but two standouts last year for us were Bitcoin and gold. Again, I think this is something that everyone was talking about, but to be honest, we made a call in June or July of last year for people to buy Bitcoin at about $9,000 levels, and it wasn't yet at a point where there was such a mania around it. So as you can see, it also, Bitcoin also dropped along with the rest of the asset classes in March, but then, you know, just really started to grow really fast. But it was really flat for much of the year until, you know, Q4 really, when it started to just its ascent. We made a call to invest in it in July when it was about 9,000, and we, of course, as everyone knows, we've hit a high of 61,000 since then. But of course, this is all before CBN's pronouncement this year. We at the time were very much believers in Bitcoin as a long-term investment. So it's still in line very much with what CBN believes. We don't believe that Bitcoin should be a replacement for a currency. That is not the case. But we've always believed that, you know, from the perspective of looking at Bitcoin as just sort of a way to get exposure to blockchain as a technology, it makes a lot of sense to have a long-term investment allocation to the cryptocurrency, not a trading allocation, but one where you hold it similar as you would with any venture capital investment. You hold it for 5 to 7 years, and that's what we're recommending for our clients. And the last one, of course, is gold, which also, you know, did quite well last year. So, oh, you can move ahead now. So another asset class that I would think it makes sense to mention, even though there are actually quite a few things that happened this year, but I would actually say much of the stage started being set last year as well, because it was actually last year that the world went through a crash course in digital, right? So I remember before the pandemic, we hold calls for our clients every month, and we've been using Zoom ourselves for a while, and we had thought to ourselves, oh, well, we'd like clients to use Zoom, but many people were like, oh, we don't know if clients will use Zoom. Well, guess what? Now everyone uses Zoom, right? So we all went through a crash course in what it means to live in 2021, right? And that, of course, benefited a lot of companies, and primarily tech companies, right? So you see that also with the performance of the S&P 500. You see the likes of companies like Zoom, you know, trading at valuations that are extreme. Pretty much, actually, much of the tech companies are trading at extremely high valuations at this point. And Africa and Nigeria was not left out, right? So given that we are primarily in, you know, our tech environment, even though we have actually had lots of tech companies for a long time, much of the stuff that's performing at world-class standard is the new tech, you know, just sort of some of the new stuff that's coming out of the young people now. And that's what people are excited about. And it's building, of course, on the work from the older generation and so on, but really, like, the credit really goes to this young generation that's coming in with world-class standard technology. And they are, just sort of getting a lot of interest globally, right? So given that, we've actually seen quite a lot of interest in the venture capital asset class. And this is something that's been building over the last 5-6 years or so, but really, I think, given what was going on globally, there was definitely quite a lot of push, given, just sort of some interesting benchmarks reached. The Paystack exit, quasi-exit, for example, is one that really did something fantastic for the ecosystem. And I think, that has sort of led even people who before this were afraid of the asset class. Everyone now feels, a certain level of FOMO, right? So really what we're seeing is quite a lot of interest there. And so even though there isn't a formal index to measure performance, we do look at certain things that have happened, like the recent achievement of a $1 billion valuation by Flutterwave, which is really, it's not technically the first, but it's the first real unicorn that achieved it within a short period of time, which is typically defined as under 5 years, right? So it's the first real unicorn. The first one absolutely is of course InterSwitch, but of course InterSwitch took much longer to reach unicorn status. So I think that's why there's so much excitement around Flutterwave. And of course, some other recent raises, Kuda's raise stands out because again, they've raised twice in a relatively short period of time at relatively healthy valuations, not public, but again, those numbers are very impressive to everyone. And I think at the end of the day that this is just, this is one in which if we were to just sort of try to establish a trajectory and an index for how African ventures have done over the last year, we would definitely say that they have performed quite well. Probably not to the level of Bitcoin or crypto as an asset class, but probably, but definitely beating probably most domestic asset classes. So that now brings us, to just sort of thinking about your investment portfolio last year. The last time we had a joint session with Union Bank, we actually talked, and this was, right in the middle of the pandemic, we talked about the importance of having a strategy to ride through the pandemic. And at that time, we recommended, a three-pronged strategy, which was to stay diversified. Yeah, so diversification was a really big call for us last year, to stay liquid as a second thing, and also to start to leg into cheap assets. And so for us, that strategy definitely for our clients worked quite well. We found that, just sort of having a portfolio, and you can see here just sort of what the kind of portfolio we were recommending for people to have would look like. It would still be one where you have a strong base of fixed income, because fixed income is really your sleep well money. And in the midst of a pandemic, it's extremely important. It becomes even more important to have that allocation. But it's the fixed income allocation, your sleep well money, that gives you the liver to take risk, and it gives you the liver to do the other things that you really should be doing in your portfolio in order to make the kind of returns that are achievable, right? So we definitely were recommending that you put a good allocation in listed equities divided between developed markets and Nigeria. As you can see, Nigeria did quite well, but developed markets also did very well, especially in dollar terms, especially in Naira terms. And then, we like real estate. In Nigeria, we actually don't consider real estate an alternative asset class. It's very much a core asset class. So our moderate portfolios actually recommend about 27% in real estate. And that's also something we recommend that you divide between developed and Nigerian real estate. As you can see, we still have an allocation to cryptocurrencies. It's a very small allocation, but this again was before the CBN recommendation. But I would also like to bring to people's point of view that our recommendation to crypto is still one that is in line with CBN's belief that crypto should not be traded, but more held as a similar to a venture capital allocation. So clearly, it would not mean that you're trading in and out of them. But of course, you can't do that now anyway with the Nigerian banking system. So of course, we've had to adjust our recommendation for 2021. We also last year, in addition to adding a recommendation for crypto in July, we also in July added a recommendation to gold. We have a larger recommendation to gold than crypto simply because, again, gold is a little bit more of a established asset class with much lower volatility and has a different role in your portfolio as well. Truth is, a lot of people talk about gold and crypto being, just sort of, similar to each other, or crypto being digital gold. We don't believe that's the case because they actually have very different roles in the portfolio. Gold protects against tail risk, right? So in the midst of something like a pandemic and remember, we have to make sure that the portfolios that we hold are set up for future situations like a pandemic, right? So the objective of last year's strategy for us was telling people that, look, even if your portfolio wasn't coronavirus ready, make it ready for whatever will come next. And something will come next. It may not be a pandemic, but something always happens, right? And gold has that role in a portfolio. It protects against tail risk. Cryptos don't do that. Cryptos work much more similar to a venture capital investment. So they can actually have very high correlations to things when things go badly. So it doesn't have that tail risk protection, but they can provide significantly outsized returns over a long term. So we actually, again, I'm mentioning we don't recommend trading crypto. So that brings us to just sort of, sorry, can you move to next? Yeah, sorry, before I end this portion, I wanted to just sort of quickly review the specific recommendations that we had for clients. Please move to the next slide. That we made for clients last year and how they did at the end of the year. So we typically, speaking to clients, we suggest trade ideas and trade recommendations from your standard portfolio. So take, for example, the portfolio that I showed you at the beginning with the allocations to fixed income, allocation to equities, and so on. That is your long-term portfolio. It's your strategic portfolio. It's something you should be prepared to hold for 5 to 10 years, right? We don't change them that frequently unless something happens. Last year, as I said, we made amendments to it. We added cryptos, we added gold. But before that, maybe I don't think we'd made many amendments to them for about 2 years or so. So your strategic portfolio doesn't change that much. However, every year we always suggest tactical trades, right? A tactical trade is just sort of, think about it like your strategic is you driving somewhere, right? And your tactical is just making a detour, right? So let's say you're driving somewhere and you get hungry and you want to, stop and get a pizza. So the point is your tactical trades help you optimize the journey, right? By helping improve your returns long-term. And so they usually work as long and shorts, right? So imagine, for example, your typical portfolio says you should hold half in Naira, half of your fixed income in Naira and dollars. Well, last year, because we believed that there was going to be a devaluation, we were recommending for people to go long USD fixed income and short NGN fixed income, right? And so that was our deval basket, which did well. And then we also were recommending for people to short duration. So just to explain what that means is if you buy different types of bonds, we could say to you, look, buy a 5-year bond or buy a 20-year bond. Well, because we believed that yields were gonna drop last year, we thought it made sense for you to buy longer duration bonds, right? Longer tenured bonds and sell your shorter tenured bonds, right? And so that also did well. The third trade that we suggested was what we call our real wealth basket. we were believers in the fact that real estate, real estate typically lags the cycle, right? So real estate is something that tends to do well after the economy has started to come out of a depression or a recession or any other downturn. So given that, we're kind of in the middle of a double dip recession now, it's actually a second one for us. We had already started to think that real estate was gonna be at a turning point, right? And so we were telling people that this is a good time for you to start thinking about, just sort of some particular types of investment in real estate. We are not strong believers in, commercial office, for example, but we like things like student housing and some of these other higher yielding real estate, and even sometimes opportunistically land. So you actually did see some definite improvement in at least the type of assets that we were interested in for the year as well. The fourth trade idea was an S&P hedge. Now that for us was something that we thought made a lot of sense because of valuations with regards to to where U.S. equities are. And again, a lot of us do invest in global equities at this stage, given that there's so many platforms that can help do that, including M36 coming up. So key point is there, for example, we had a recommendation that you could short a small amount of US equities and buy other type of developed equities and emerging equities. The reason we called it a hedge is that most of these developed markets still move very closely and they have a strong, what you call beta to US stock markets. So that means if US moves up, they would also move up, but they're not as overvalued as US markets, right? So they give you a little bit of that exposure, but hedge you in case that there's a downturn. But of course, S&P did really well last year. So that trade didn't really do that well. It was kind of flat. But again, it ended up being, it's one that we still have on now and we'll probably keep because it still makes sense this year. But that trade was flat to, it's just up 1%. And that was primarily driven by emerging markets doing slightly better than the S&P, but EFA, which is the other developed markets, so it would be, Europe, Asia, Far East, underperformed the S&P. So overall, the basket did almost the same as the S&P, but it ended up being a good value hedge because that way you weren't exposed to, you weren't overly exposed to the high valuations of US stocks. Then the poorest performing trade, actually, our only negative performer was our allocation to gold relative to USFI. But it didn't perform too badly, but it was down for the year about 4%, at least from the period that we made the recommendation. So, and that was mid-year. Gold did well for the year, but definitely for the period from the recommendation is mostly flat, but it's still a very good hold in your portfolio. So it's still one we like and we have actually kept. Of course, our granddaddy trade idea was the crypto trade, right? Which everyone understands, given what crypto has done. Through the end of the year, so I mean, we made the recommendation at around 9,000 and it ended the year at about 29,000. So that was almost 3 times. That just sort of was the trade that did the best for the year. But we also had an allocation to Nigerian stocks funded from your fixed income allocation, and that also did really well at 46%. So that's just a summary of just some of the things that we recommended last year and how last year went. This would also, handing over back to David, just with, it'll be a good point to take questions from people if they have questions about last year, but then we can also start thinking of talking about the outlook. Back to you, David.
Thank you so much, TT and Olayemi, for that insightful breakdown and analysis of 2020 in retrospect. If you're just joining us, you can drop your questions in the question box and we will make sure to pick it. One of the things Titi mentioned was the devaluation of our currency. And I'll just like to throw this to your line based on this webinar. What's the outlook currently on the macroeconomy in Nigeria? Thank you.
Hi, David. So I think as far as devaluation goes, in terms of an outlook, I think we've seen the worst of it for the fact that oil prices are on the rebound. As everyone is aware, we're a largely oil-dependent economy, and shocks to the oil price are pretty much the primary thing that causes fluctuations in our currency. We're seeing a stable oil price at about $62, which is well above our budget benchmark of about $40, and production stable. So with the devaluations that we've seen, I think we've seen the currency move from sort of about 380 to about 420 as far as the exporters window. And last year we saw the official rate move from about 307 to about 380 now. I believe we've seen the worst of it. Knock on wood that we don't enter another tumultuous period now that the vaccine rollout has come and the positive signs around the global economy of reopening, and that should stimulate output. I think that as far as the currency, we won't see more of a depreciation as long as things stay stable. So, it's a bit of a crystal ball question, but the macroeconomic indicators at the moment suggest that we should be able to sustain our currency at the current levels. The outlook at the beginning of the year was that we would probably see some form of a devaluation or depreciation in currency to somewhere around the 430 levels. So we might still have a little way to go, but I don't see that given the current macroeconomic indicators that we move aggressively from that point. So I think we're relatively stable from this point on.
All right, thank you. Thank you so much for that detailed answer, Olayemi. And over to you, back to you for the presentation. Thank you.
Okay, so I think that's a good juncture for us to kind of look forward a little bit from 2020 and kind of just take a beat and see where we are as far as what's happened so far in 2021. So budget spending was set somewhere around 13.6 trillion. That created a deficit of about 5.2 based on revenue projections. The Debt Management Office, Central Bank, plans to fund that 50-50 splits between local borrowing and foreign borrowing. The local borrowing component and the size of the deficit, I think, has buoyed the fixed income markets. We've seen rates spike in recent months simply because of the size of the borrowing that the Debt Management Office has to achieve. So I think most of the market participants are betting that we see increased interest rates, which has already begun to materialize this year already. So we've seen rates push up from lows of about 6% on the longer end of the curve to about 13%, which is a positive for investors. And we've seen renewed investor interest in not only the bond market, but also at the shorter end of the curve in the treasury bill market as well, because we've seen yields in that market also rise from about 2% to about 8% levels. So this increase in interest rates, is a direct effect of that expectation that the market has, but also because the central bank needed to do something to kind of encourage some foreign flows to kind of buoy the currency. That said, since oil prices look stable and are looking positive, we might see them be a little more conservative as far as letting the rates go, because there's obviously a cost element that exists with raising debt, right? As far as also raising foreign components on the debt, I think today in the news it's come out that they began the process of shopping for advisors for potential Eurobond issue. We suspect that will probably come sometime around Q3 after the process of getting the advisors and getting approval from the Senate and presidency. And should they be successful in raising that debt, then we might see local interest and environment moderate a bit, and the current sentiments of high double-digit interest rates will be tempered a little bit. So I think we're getting to that point where it's a good time to start looking at the market and looking to invest. Also, I'm sure we're all aware that the central bank has been doing everything they can to keep things stable. There's the dollar for naira policy, which they instituted to try and attract foreign flows from the diaspora market, which is a huge untapped resource as far as getting flows into the country. That, in addition to the fact that they changed the policies where the IMTOs actually have to pay you in dollars into your current accounts when that flow comes. All of this being done, to try and keep things stable and to try and avoid having to devalue the currency or try and stem that depreciation which they see. There's still some concerns. Obviously, our macros are still not looking that good. You have inflation somewhere around 17.33%, the February figures that came out. And we have very high unemployment, which is as a direct result of lower output and the recession, which we just came out of at the tail end of 2020. That said, as the expectation is that things will continue to improve with the global economy, and as economies reopen, we expect that we begin to see some positives, right? Just looking at some outlook estimates, we have GDP growth, our best case being somewhere around 2.5, our worst case at 0.4%, which is still positive, but obviously, we'd like to see an improved GDP growth rate to stimulate the economy. Fixed income yields, estimate was that we would see the 10-year somewhere around 14%. That we expect to come to fruition. I think in the last couple of days, we've seen a spike in yields where you have sort of the longer end of the curve. I think a 30-year sort of around the 13% levels, 25-year around 13% as well. 10-year not lagging too far behind, about 12.5. In terms of the crude prices, I think we're around our base case scenario. Crude oil at $62 per barrel is a nice $20 cushion above where our budget benchmark is. If you look at the parallel market rates in terms of the estimates, we're somewhere around 485. I think the worst case scenario is north of that, around 500. I think given current macroeconomic indicators, we possibly won't get to that point. So I think current levels are sustainable. I'm not sure we see an appreciation, even though that's what the optimists would want to bet on. But I think somewhere around the current levels is sustainable in the short to medium term until we see what the real effects of the global economy reopening are. Foreign reserves, the base case is somewhere around 34, which is currently where we are right now. So I think as far as the expectation, if we see that continued stable, relatively higher price and production doesn't get interrupted, then we'll definitely see some growth in the foreign reserves if we're also able to attract some foreign portfolio flows into the market. In terms of the monetary policy rate, we're currently at 11.5. The central bank has kept it stable. There are arguments on both sides for either an increase or reduction, but I think the reason why they've kept it stable where it is to try and continue to stimulate growth. And increase to try and battle inflation right now would be detrimental to our local production, simply because there are structural factors that are causing the rise in inflation, which is tied a lot to food, with the border closures and some other structural issues. So I think we'll probably see the monetary policy rate also stay stable at the 11.5 levels, while the central bank allows the effects of that to kind of permeate into the economy as we're trying to boost growth. Output growth is extremely important. And once the food crisis is addressed, we would see a moderation in inflation. So raising rates in order to tackle inflation or to kind of augment the return to make it a more positive real return is not beneficial in wider macroeconomic sense of things, right? So in terms of setting the right investment strategy, I'll bring in to say something about balancing portfolios and where you should be. Everybody right now the question everyone asks is, where should I put my money and when, right? Timing is extremely important, as important as what asset classes to put in. Obviously, people are concerned about inflation. They want a return that would beat inflation. How realistic is that? They're worried about interest rates rising. I have to watch my timing. Do I want to invest at the bottom, or do I want to invest at the top and make sure I catch the top of the market? And also everyone wants, assets that will give you, high valuation. So the question, on everybody's minds, and while we're here to advise and take questions from you, is where should I put my money and when? So I'll bring in Titi here to share her thoughts on that.
Thank you. Thanks for that. And definitely, I do think, the year is looking to be one where sure, things may be getting better, but probably, slower than we would want, right? So I definitely do think it's one where when it comes to what to do with your money, you also have to be very thoughtful about it. So last year, remember we said diversify, stay liquid, leg into cheap assets. Well, we continue to recommend that you continue to, be diversified. And the cheap assets that we're focused on really are real assets. So our theme for 2021 is buy real assets. And please go back, sorry about that. The key reasons we're interested in you buying real assets are for three primary reasons. One, we're in an inflationary environment, right? So in an inflationary environment, you're gonna see a lot of things happen. You're gonna see your needs for return grow. However, investing in fixed income may be a bit tricky because of things like rising rates, right? So take, for example, because rates are rising, even you as an individual investor, you're gonna end up seeing that a lot of people are not gonna give you the kind of rates that you want still, because they're uncertain where rates are gonna go. And even though rates are still rising, they haven't gotten to where they're gonna go, and they are not yet stable. So people are still in a very speculative mode. You're gonna see a lot of people going short. And so if that's the case and people are going primarily short, the people that you as an individual, you're not going to be able to get the kind of return that matches the inflation that you're hearing. So you're hearing inflation is at 17%, but your asset manager wants to take your money at 5%. Does that really make sense for you, right? So inflation, rising rates, and then the fact that, okay, well, you're not getting what you would want. Sorry about that. So you're not getting what you would want in fixed income. So then do you now want to go into, other type of financial assets? Well, that could be a problem as well, because asset classes are so highly valued right now, right? So I think that what you want to do is start thinking about real assets as much as possible and start to think about how to, now remember, right, this is on the margin with your already existing portfolio, right? So you have a portfolio that has to be diversified across a wide range of things, right? So remember, you first of all have to say, look, where am I going to put all my money, right? Your first thing is to diversify and stay liquid. Remember, I mentioned that, right? So if you diversify and stay liquid, you have to have fixed income as your base, no matter what the yields are, just for security. But what I think people are always asking us is, okay, so my risk money, where do I put it? And your risk money should go into real assets. Your risk money should be saying, okay, well, let me go buy assets that are linked to so agri-finance notes. You may be thinking about assets linked to real assets, for example. So that's also an important thing. So take, for example, Union Bank, for example, can offer you products that are tied to financing agriculture, financing real estate, and so on and so forth. Those products will actually give you higher yields than you would actually typically typically get in other things. And additionally, this is a very good time to also be thinking about venture capital, to think about you know, some of these other assets that are not what you're typically thinking of. So it means this year you're going to be looking at your overall portfolio. This year you may not, like your 50% in fixed income, you may actually say, all right, well, let me take the amount that would go into equities, right? You always keep that, if you're a moderate risk investor, you would always keep that 50% in fixed income. But then the amount that goes in equities, because financial asset valuations are so high, equities may be tricky this year, right? So this year, your equity allocation may now go into other things. It may go into real estate, you may go into commodities, you may go into gold, and so on and so forth. So definitely, real assets really make a lot of sense this year. So moving on to the next page, just with just specific ideas that we think you can look at, right? So real estate, I mentioned earlier. Now remember, there are many different ways to do real estate. You can do direct real estate, or you can actually do real estate financing, right? So those are some of the things that kind of make sense this year relative to fixed income. Then with regards to, I mentioned the S&P hedge as well. So for those of you who are already investing in the stock market globally, you want to be thinking of hedging against a potential drop in asset values, right? So if, for example, there's going to be a drop in asset values, it may make sense for you to invest more in emerging markets and other developed markets other than the US, and short US equities. Additionally, on the agriculture side, I definitely like agriculture over just keeping your cash in fixed income. So agri-finance notes make a lot of sense at this point. So definitely that's something worth looking at. Then definitely shorting duration as well, right? So shorting duration makes a lot of sense. You want to be thinking of going a bit shorter on the yield curve rather than longer. So last year was the year to have bought like 10, 20-year bonds. This year, you want to be a bit careful until there's a bit of stability in the rates. And then with regards to innovation, again, you know, this is the year to be thinking of real assets like venture capital, and thinking about the type of things you want to do with regards to venture capital as well. Now, it's not everyone that has access to that, but again, you know, M36 and Sankore are gonna be thinking of those type of products in order for us to be able to have you get access to those type of investments as well. Additionally, you know, we talk about cryptocurrencies, and given the CBN rules, we can no longer directly recommend investing in Bitcoin in the typical manners. But again, you know, if there are products that give you exposure to blockchain, which is really the core of our recommendation, this would be a good time to do that. So if, for example, you can invest in a company that's building something, you know, just sort of as part of your venture capital allocation, investing in blockchain technology-based companies, that could make a lot of sense. If you happen to have access in other ways that is not tied to the Nigerian banking system, then it's still something that makes a lot of sense. And I do think, you know, CBN and SEC are going to figure out, they're going to figure out how to give us access to this new technology without disrupting our banking system. I do think that within the next year or so, we will have a way to separate the securities and investment aspect of crypto from the speculative and trading aspect of it. And I think it's something that will hopefully happen soon. And then of course, gold, we do like gold. And so these are just sort of trades for you to think about with regards to your core portfolio. Always remember though, that your core portfolio must stay diversified and your core portfolio must stay liquid, right? So it's always important to think of the page that we showed earlier. I don't know if you can go back to page, I'll tell you when to stop. Keep going. Keep going. This page. So it's always important that you look at this page with regards to what you should do, right? Because I do find that a lot of people think investing is about trades, right? Trades are small things. The big thing that determines the money you will make, whether you make your money for retirement, is what you do with your long-term allocation that you're not changing all the time, right? So if you don't have a long-term allocation, you should get one, right? And so that's what this is. This tells you that if you're a moderate risk investor, you want to start out with 47% of your assets in fixed income. You want to first of all have taken that allocation and made sure that you are stable in fixed income. And whether the yields are high or low now, it doesn't matter for that point. Then once you have that, you can now start to think about, okay, what are the fun things I want to invest in that can, grow my portfolio? And that's where you now start making the changes. This year we're shorting equities, Nigerian equities specifically. We're shorting Nigerian equities and more interested in things, other real assets. So you would then be looking at things that sit under private equity and venture capital, under real estate, under commodities, and so on and so forth. So that would be what we recommend that you do with your portfolios in 2021.
Thank you so much, TT. Thank you so much, Olayemi, for that very insightful and in-depth analysis on this. So for now, we'll be going into our question and answer segment. And for all our participants that just joined, you can actually drop your questions in the question box, and we will be taking them. One of the questions we got during the presentation was in regards to investment strategies. And I would like to direct this question to TT. TT talked about the effect of 2020 on the venture capital space. A question on the minds of our participants is, how and when should a customer or a person consider getting into the venture capital space? Thank you.
Sorry, can you repeat that? How will a person get?
Yes, the question is, how and when should I, like the person says, consider getting into the venture capital space or invest in VCs or companies?
How and when? Okay. I think, so typically, right, the recommendation is that venture capital is something that very savvy, high net worth individuals should do, that they're the only ones who, I generally don't agree with that because I think us as Nigerians, we all do venture capital in our way, in our small way. If you've given money to your cousin who wants to start a small business, you've done venture capital. If you've lent money to your driver, if you've lent money to anyone, if you know what I mean? So you've done small business financing, you've done venture capital, you've done angel investing. Now, of course, there's now a different class of businesses that's, of course, much more institutional and much more likely to succeed. But I point that out in order to point out that, look, we're already taking this risk in our day-to-day lives, right? People are already lending money to people, right? Nigerians generally are just very social people. We are all very interconnected and very willing to support ourselves, right? So people are already taking this risk. So given that, it may make a lot more sense for them to continue to take this risk in much more structured formats and in companies that are more likely to be successful. So we do believe that, there should be retail structures that exist for, for retail investors to get access to venture capital. I think these type of structures are really being built and in process. So really, unfortunately, there's not a place I can go to for you to say, okay, well, go here and you can invest in a venture fund. But I do think that over the next few years, we should see some of these funds, be launched that would allow, a smaller amount of money to be invested in just sort of, best in class companies. And then, just sort of with regards to, so I think I've answered the when question, just, and I think the other thing to think about is, if you just happen to be interested in it, there are actually lots of, small groups of people, syndicates, and so on and so forth. It's just that you have to know the right people. So it's not really at a point that it's retail ready, right? But if you do have a little bit more liquidity, right, then there are, there are lots of communities that are available. So I would suggest people get together in groups and do some research. But also, let's never forget that you should be very, very clear about your allocation to venture capital. The reason I showed you that chart earlier is that you really should not be putting that much of your overall net worth into venture capital or private equity. It's a very small percent of your portfolio. So even this year, when we're saying overweight things like that, really, especially for young people can take a bit more risk, but I would be very against anyone going beyond 5 to 10% of their net worth, even a young person, in venture capital, unless of course you're the entrepreneur. Then entrepreneurs do different things in that case.
Thank you so much, TT. Thank you so much.
Pleasure.
The next question goes to, I would direct this to Olayemi. A participant is asking, looking at all the macroeconomic indices, is it likely that the dollar-naira exchange rate will get better in favor of the naira? Olayemi, what's your take on that? Thank you.
Interesting question. I would love to believe that it will, but all the indicators right now and the structure of our economy point towards the fact that we'll remain stable. I'm not sure we're going to see a marked appreciation in terms of dollar-naira, right? But I think the outlook is stability. I think we also have to be wary of the fact that, like I said, because we're such an oil-dependent economy and we're susceptible to shocks, right? Any slight shock in terms of global output or prices, would put pressure on the currency as it is, right? An appreciation would only come after a prolonged period of extremely high prices and high global output. So I think a more conservative view on dollar-naira would be that we stay stable. And as far as history, right? If you look back as the trajectory of dollar-naira over the past couple of years, right? We haven't had that many periods of appreciation, right? And the issues are structural. The issues are, well known to all of us. We live here. We engage with the currency, so we know what the issues are. And that appreciation that we hope for, we wish to see, can only happen on the back of a lot of structural reform, fiscal and monetary. So my short answer is we stay stable, and a hopeful appreciation is probably not on the horizon. But yeah, stable is my bet. I don't know if Titi has any thoughts on dollar-naira that are contrary to mine.
Not contrary. I think I agree with you definitely on the INE window. And I think I would just add a little bit more context that there are slightly different things that can happen on the just sort of the parallel market, which is, of course, it's not, the parallel market is technically not a market that, it's really, unfortunately, the market that most individuals think about, right? Because it's the only one that you really have access to. So that market has the potential of moving and moving in a direction that could be considered somewhat of an appreciation. But I think you're very right, is that, again, we have structural issues that are not going to allow an appreciation, but we do have an anomaly right now, which is that there's a massive gap between the parallel market and the official market, right? So INE window is around 410 or something like that, whereas parallel market is 480, right? And remember, before this recent issue with the currency, parallel and official were 360 and 365 or something like that, right? So that opportunity of the gap closing is something to keep in mind, right? And I say that because I still see individuals hoarding dollars. And I point out to them that it is a very bad move at these levels, because if you're going out buying dollars at 480 and 490, it doesn't make sense for you to do that from a long-term perspective, because the gap will close at some point. And if the gap closes, take for example, the CBN is going out now to raise dollars on the global market, right? I don't know what you think, Yemi, but what will that do to the exchange rate, right? Because the last few times this happened, the gap closed, right? And then I don't know if you remember in 2017, or was it 2017, 2018?
Yes,
Naira
you're
was
right.
at 550 something. Do you remember that?
Yeah,
And
so
it
I guess if we're talking about
to
the gap
360.
in between the parallel and the official rates, then yes, definitely there's some room for appreciation there.
Yeah,
I think my comments earlier were to the official rate.
INE, of course,
My
which is
central bank
the,
governor will
yeah,
tell you is our
is our
only rate.
only,
Yes.
yes.
But
But
yes,
you know, I'm speaking for the
as,
people.
as
I'm
far as the
speaking for the people who
people's
don't
rate,
have
right?
access to that.
As far as the people's rate and the parallel market, then yes, there definitely is room for some conversion between the two rates.
Yeah,
I think we're about 60 naira, the differential, and you're right. Before we went into the pandemic crisis, I think that differential was from around 5 naira, sometimes even slightly less. So if the debt management office in Nigeria as a country is successful in raising a sizable amount of dollars in international capital markets, and that gives them a lot more confidence to defend the currency and to exact policies which would push a convergence, right? And the holders, obviously, at that point would come out and begin to, sell,
Yep.
which would lead to that appreciation, right? So at the peak of the crisis, I think it's the natural fear for most people to fly to safety, and they see safety as buying dollars and hoarding dollars, even though the central bank has done a lot to try and discourage people from,
Yeah.
dollarizing the economy or hoarding stacks of dollars. So I think if you're speculating on the black market, and definitely there is room for some appreciation of the black market, especially now that we're seeing stability as far as the official rate. So please be careful with why you buy dollars and where you invest in, and not to get caught on the other side of appreciation.
Yep.
Thank you so much. That was a thorough analysis. That was a thorough deep down. Speaking on the same topic, borrowing from the international market, the question here says, is the federal government going to issue any Eurobond this year? It's quite definite, and allow me to address the question.
So incidentally, news actually came out earlier this afternoon that the debt management office is in the process of shopping for advisors to a possible Eurobond transaction sometime later this year, as we earlier stated. So in the budget, the facility to borrow internationally was already estimated into our budget. I think the plan was to borrow 50% of the deficit locally and 50% internationally. And I think now that you're seeing local interest rates rise, and dollar rates are relatively lower and have come off this year, I think now the debt management office thinks it prudent to tap into the international capital markets and get relatively cheaper funding in dollar terms. I think last year, the only reason why we didn't see them going to international capital markets was because obviously local rates were a lot lower, and it made a lot more sense to borrow locally, especially when you're doing it at cheaper interest rates. But we expect that so they don't overheat the local interest rate environment and have to pay exorbitant costs, they will tap into that Eurobond market. And I guess the process has already kickstarted. So I think we just pay attention to the progress that is made once the advisors are picked and announced, and then it possibly goes to Senate for approval. And I'm sure that process will probably be concluded sometime in Q3.
Thank you, Olami, for that answer. This question is directed to TT. The question says, what would you advise a risk-averse client that is looking at investing in the short term with good returns? What would you advise them to invest in?
The risk-averse client, I actually already gave you my framework, right? It's very simple. A risk-averse client, or even any client, needs sleep well money, right? And especially a risk-averse client needs that sleep well money. The idea being that, look, at the end of the day, the only thing that you can invest in that will not give you palpitations in case something happens is really fixed income. So we always say that you have to ensure that you have that done first. When you have enough fixed income, guess what? You actually get a lot of confidence to do other things, actually. But a risk-averse investor won't even want to do those other things because they don't want their portfolio to move at all. So if I use the most extreme risk-averse client, that client really just needs to, have other people take risk, right? So you just go to Union Bank and you say, I want to do a fixed deposit. How much? That's it. But even moderate and aggressive investors should do that first, right? The first thing you always want to do is, first of all, just make sure that you have an allocation that you are not playing around with. There's no joke. There's no, in addition to calling it sleep well money, you can also call it no story money, right? No story, right? Like, I don't want to hear something happened, and let's be clear, right? There are lots of things that we see that we're all attracted to, Someone came to me and said, oh, yes, well, I see these agric things and they're offering 30%. I said, look, risk is correlated to return. You have to keep that in mind, right? So when a few of them last year defaulted and so on and so forth, I was surprised that people were surprised, right? Like, at the end of the day, there is no free lunch, right? It's good to actually have allocations to those things, but you have to size it appropriately, right? So at the end of the day, I like agri-finance, but I will always make sure that I'm picking the right. Number one, I'll first of all size the allocation appropriately. If you look at our allocation, I don't think we'll put anything more than 5% of a client's net worth into commodities. Then even that 5%, you're not going to put everything with one institution. You're going to spread it across institutions so that your risk is also measured, right? And you also want to understand the underlier, right? So even for our agric allocations, we do it with counterparties that are vetted. So we partner with the likes of AFEX, which is a commodity exchange, to ensure that we're not putting money just anywhere, right? So a risk-averse person, right, and even a non-risk-averse person, they still all need the same thing. No one wants to throw money away, right? Everyone needs to have a base of fixed income, sleep well, no story money, right? And a risk-averse person just needs more of that than other people. Then, if you're risk averse, you may also want to say, okay, well, I can, my real estate allocation can be a little bit bigger. We said you should put about 20-something% in real estate, so maybe a risk averse person would not be looking at venture capital, right? So if you're telling me you're risk averse and you want to do venture, just be aware those two things don't match, right? Venture capital means you are comfortable not looking at this thing for 5 to 7 years, you're comfortable completely losing your money. You're in each individual investment, right? If you're not comfortable with that, you should not be taking that investment, no matter how much FOMO you feel, right? So the key thing at the end of the day is being aware that risk and return are correlated. If you are, you are someone with low risk tolerance, then you have to be satisfied with lower returns, because you're at least going to know that you can sleep well at night because that's what you prioritize, right? So that's the long way to answer that question.
Thank you so much, TT. Speaking on traditional investments like fixed deposit, a question here comes in that regard, and it says, seeing the trend with the federal government savings bond that the person mentioned specifically, and the treasury bills, and basically the traditional options of investment, do we or do you particularly expect that the rates to keep on rising, and what is exactly pushing this rate up?
So I think to answer that, the first thing I'll say is nothing goes in one direction forever, right? So as far as do we expect rates to keep rising, so the expectation of higher interest rates is simply on the back of the fact that the marketplace expects, which is the reality, that the federal government through the debt management office has a large deficit to fund, right? And people are also estimating that the revenue is not going to meet up with the expectations in the budget. And so the market is pricing their liquidity at a premium because they know that the debt management office needs to borrow a significant amount. That said, if they're successful in raising money from the international capital markets, that's going to do a lot to reduce the pressure that they're under. And at that point, you might see them moderate and not be willing to offer interest rates at these relatively higher rates once they're on their trajectory towards funding the budget comfortably. So I think as far as an entry point, which would be ultimately what the question serves to answer, you need to pick where your threshold for returns is, right? I always advise to invest at every level of interest rates, right? So, if we're at 6% and you're comfortable there, but then, you have a little fear of missing out of the 8%, why don't you invest 25% at this level, right? If it goes to 8%, then you still have some more to invest. If it drops to 5.5%, you feel comfortable knowing that at least you did some at 6%, right? So I think stagger your investments, but at the point where it meets your return threshold, then begin to invest, right? And ultimately, don't be too greedy. Like I said, nothing goes in one direction forever. And each individual's investment threshold is different. Each individual is looking for, different returns. But I think very important, something that Titi said is the size of your capital as well also determines the kind of return and as well as your risk appetite levels, right? You can't be slightly risk averse and be looking for, high double-digit interest rates, right? So I think watch the markets carefully and take a decision to invest along the curve so that you don't miss out. And also pay attention to the macros, right? It's important that with whatever investment decision that you're taking, that you've done some careful analysis. If you need to speak to a financial advisor, please do so, someone who's more knowledgeable, and let them give you some advice. Balance that against what your risk threshold is, what your return preference is, and then take a decision as to where to invest in terms of the interest rate spectrum. TC, I don't know if you have something you want to add there or.
No, I actually agree with what you said. So, in fact, you even talked about something that we really are believers in, which is this whole idea of legging in, which is, it's an acknowledgement of the fact that no one makes perfect decisions in investing. And it's an acknowledgement of the fact that, look, if there's something you're worried about with regards to an investment, just do it over time, right? So I know lots of people who, wanted to invest in, and I'll just use the example of crypto when we talked about it in July. Again, as I said, that was last year before CBN, but they wanted to do it at that time, but they were too nervous to do it. A legging in strategy would be, okay, you should put 1% or 0.5% of your net worth in crypto. Why don't you start doing it little bits every month, right? So that you're not worried about losing all your cash, right? So it's just sort of taking you in slowly and out slowly. So legging in, just like when you're entering like a cold pool, right? You just put one leg in first, right? And just go in slowly. And so it doesn't lead to any sort of shock, right? So by the time you've done that, you end up with an average cost, right? So it's not an extreme situation in any direction. So I agree with what you said. And I think, those sort of strategies really help people manage risk.
Thank you, Titi and Olayemi. Here's another question in regards to investment. One of the slides that Titi, so I think this might be directed to Titi. One of the slides that Titi talked on, she talked about emerging FI, and the question says, outside of Nigeria, what other emerging markets should one be looking at?
Does that say emerging fixed income or emerging? Because
Generally,
again,
emerging markets.
No, I'm saying, was it specific to an asset class? I thought I heard you say emerging FI or just emerging markets generally.
Yes, that was a reference to one of the slides you talked on. So maybe that's
Okay.
probably the base of the question, but then
Right.
the question is for emerging.
So with emerging markets, again, it depends on the asset class, but it's a big world out there. There are lots of markets to think about. I think as Nigerians, we've started to become a lot more interested in other markets, right? So over the last few years, you've seen lots of platforms come out with providing access to foreign markets and so on. So a lot of people are already saying, oh, okay, I can invest in the US. So now there might be other countries. Yes, there are lots of other countries, right? And there are other frontier markets, other emerging markets, other developed markets. So that's usually the categorization, right? At least from a financial standpoint, we think of developed markets being, US, UK, France, Germany, Japan, all those markets. Then you think of the emergings as China, Russia, India, Brazil, even though, to be honest, I'm not sure if these markets really should still be called emerging at this point, but because of the index, they're still called emerging markets, right? The ones that are where we are called frontier markets, right? So you have Nigeria, Kenya, a bunch of other countries, all kind of like at this level of growth. So it's a big world, and there are lots of opportunities. The issue tends to be, at least for the average individual, the issue tends to be whether it makes sense for you to do the work it takes to understand those markets. To be honest, I usually just recommend for the average individual to buy indices as much as possible. So it would mean that instead of looking for many different emerging markets, you can actually buy the entire emerging market, either debt or equity index, because then you don't have to know specifically which one, because it does take a lot of work to stay on top of all these different markets. I find, by the way, that investing is one of those spaces. Maybe I should have thought about this before I picked a career, but investing is one of those spaces where everyone thinks they can do it. So you know how if you are a doctor or a surgeon, no one thinks they can do your work, right? But investing, everyone thinks they can do it, right? And the truth is that attitude is actually beneficial for many traders, because then it means that, there are just more people that are trading against you, and it's kind of like a kind of market where one person wins, the other, so it's a zero-sum game type of market. So people tend to be much more confident about their ability to beat the markets than they should be. So we usually typically tell people it's good to be educated about these markets. It's good to learn the markets, but also just get a guide, get an advisor, speak to someone. And if you don't know, get an index, just buy an index. Don't bother trying to pick stocks. So, and I'll say this, it may be a bit controversial, but if you made money in Tesla this year, it does not mean you're a good investor, right? It does not mean you're a good investor. It just means pretty much you did something that many people did, and many people made money in Tesla this year. You are not a good investor because you made money in Tesla this year. that may be something that a lot of people don't want to believe, but to be honest, it's the reality of things. You know, you see people make money in one period and extrapolate that to mean that they have investment skill, right? The key thing at the end of the day is, yes, maybe you could have the skill if you spend 8 hours a day doing it, but you probably have another job, right? So just like you wouldn't bother doing your own dental work and so on, it makes a lot more sense for you to try to work with an advisor and just be aware that, you know, there may be things that, you know, sure, I mean, for many people, it's a hobby as well. But for the allocation that's a hobby, make sure it's not your entire net worth. And it's generally better for you to just sort of think through working with someone on your overall portfolio, on your life's plans, on trying to put together a structure that makes sense for the long term. So that I think would be, you know, what I would suggest with regards to emerging markets. There are just so many markets. It's hard for an individual to get a good handle, right? But for now, you know, there are just lots of markets. There are lots of interesting markets, both on the fixed income equity side, both on the even other asset classes as well, right? So
Thank you so much, TT. Thank you, TT. And our final question will be in that regard. Olai made mention on the dollar naira returns, and then he talked about euro bonds. And I think this is directed to him, but I also like to have both speakers impute on this. The question says, do I need a separate investment strategy for FX and naira? So for both my FX funds and my naira funds, do I need a separate investment strategy for both of them?
Okay, let me chime in on this. As far as separate strategy, I think in line with what Tidi has said, on numerous occasions during this call, definitely you should allocate different parts of your portfolio to different investment classes. So, considering the trajectory of the currency and what has been, if you look at history, it does make sense to have some exposure in foreign currency. So I would say definitely you should look to do some foreign currency investments. Obviously, that part of your portfolio would give you some stability and would also act as sort of a hedge against possible future depreciation or devaluation, right? But I think that now you're seeing the Naira interest rate spectrum also provide decent returns as far as vanilla asset classes, and also very interesting, which is something that TC brought up, is the venture capital space. I think we have a lot of HNIs who can actually effectively participate in that space who don't do enough. Most of the funding in terms of later series stage funding is actually coming from outside the country, and so I think the balance is good. Definitely do have some foreign currency investments. Eurobonds offer a perfect way for you to earn a stable return in foreign currency. And the possible Nigeria Euro bond being issued later this year is a good way for you to do that. There are already existing bonds in issue, and you're not only limited to Nigeria in terms of the Euro bond space. You have quite a few options, corporates as well as sovereigns. So I would definitely advise for you to do some of that.
All right, thank you. TT, do you have any input on that also?
I agree with what Yemi said. I think that makes a lot of sense.
All right, thank you so much. Thank you, everyone. That brings us to the wrap up, the end of the question and answer session. I'll be handing over to Olayemi now to talk briefly on our investment platform M36. Thank you.
Okay, so the main reason for the webinar this evening is to reintroduce you to our investment platform, M36. A lot of people are wondering what M36 is. M36 is our online platform for investment and lifestyles, right? It's a digital platform where we offer investment solutions to our customers. It's built to allow you to access the app on your own and to be able to make investment decisions online real time for your comfort and ease. On there we have investment options, treasury bills, commercial papers, bonds, a variety of FX products, switches, swaps. You can even buy your personal travel allowance or business travel allowance on the platform. We aim to scale the platform to also add lifestyle options in the future. And, Sankore is also one of our partners, on this platform where we provide investment options and outlooks. So please sign up. The app is available today for download on Google Play and the Apple Store. So please download, sign up, you get valuable information and tips in-app. A lot of the things that we've talked about in terms of the investment options we've made available to you on the app. The app is very engaging and it's a very robust app. It just gives you access to investment and to be able to deploy your funds wherever you are in the world, online, real time. Please engage with the app and give us your feedback. Thank you very much.
Thank you so much, Olayemi. Thank you. Thank you, Titi. Our special thanks go to our speakers today, Titi Odonfa Adeoye, who is the founder and chief investment officer of Sankore Investments. Thanks also goes to Olayemi Agbe Davis, who is the chief dealer at Union Bank. Thank you everyone for participating in this session. I trust that the session has been impactful and highly informative, and in some sense inspirational. We believe that you've received some help for your investment strategies like we talked about, and you've received ideas on managing your portfolio effectively. This is a great time, like Olayemi just said, to download the M36 app, and it's our digital investment platform that gives you the freedom to choose how to grow and manage your wealth. Please contact us for more information. And if you would like to follow us or watch this again, you can check this up on social media on Facebook. It will be live. Thank you once again, and do stay safe. Have a great day.